Hello and welcome to week 11 of Business Economics. This unit is concerned with how economies operate in a global, open environment. We will examine the basic macroeconomic concepts with respect to trade and exchange rates. In addition, we'll examine the effectiveness of fiscal and monetary policy when operating within an open economy. Lastly, we'll examine the impact that globalisation has had on Australia and briefly examine the currency crisis that plagued Asia in 1997 and the more recent financial crisis in Greece. When we refer to an open economy, we are referring to an economy that interacts with the rest of the world through the exchange of goods and services, the sale and purchase of financial assets, and one that has lower levels of restrictions on competition, albeit not necessarily none at all. The balance of payments is a key statistic for an open economy. The balance of payment records the international transactions between economies. These economic transactions include exports and imports of goods and services, international flow of income such as dividends and interests earned by foreigners on local investments, both foreigners investing in Australia and Australians investing overseas, and other transfers such as foreign aid and assets being transferred across borders. The current account deficit measures the extent to which Australia draws on foreign savings to fund that portion of national investment that is not funded by domestic national savings. The Australian economy over the past 50 years has persistently ran current account deficits, which have resulted in a rising net foreign liabilities. The current account deficit has a direct influence on the level of foreign debt. When imports exceed exports, a country is left with a trade deficit. That deficit has to be covered either by borrowing from foreigners or by foreigners investing in the ownership of domestic enterprises. That is, the difference must be covered by debt or equity. For most countries, increases in the current account deficit have been funded through the increase in the level of national foreign debt. An exchange rate is the price that you can exchange one currency in terms of another currency. The actual rate of exchange differs from currency to currency and depends on a number of economic variables such as the balance of payments, the level of foreign debt, domestic fiscal and monetary policy, expectations, and lastly, the size of the economy. Exchange rates have a large impact on trade in an open economy. For instance, an appreciation of an economy's exchange rate will result in the following. Imports will be less expensive for domestic consumers. However, exports will be more expensive for foreign consumers. Therefore, the terms of trade are likely to worsen. If an exchange rate depreciates, the opposite of the above would occur.